Long time no see.
Yeah, seems like forever. Not. Okay, it's time to start class. Not everybody's logged in yet, but we can't keep waiting. So I'm going to share the screen here. And this is where we left off on Friday last week. And so let's move on to the next slide. So they asked the question on the previous slide. Not-for-profits would like, not ask the question, but it implies a question. Not-for-profits would like to allocate some of the costs of fundraising appeals to program elements. Because the more of their spending that's classified as program, the more efficient it makes them look to donors. So how would you know whether or not a fundraising campaign would actually be part of your program or not? So first question to ask is, does this communication help meet program goals and functions? What's the audience? General audience? Or is it just a list of people who already gave? If it's a general audience, then it might be possible to consider some of the costs of this as an advertising campaign that's raising publicity about the issue that they're concerned with. And what's the content? Is it asking for people to volunteer to do something, or just give money? Accounting for investments held by not-for-profits. Oh, I think we went over this. Investments with readily determinable market values should be carried on the balance sheet at fair market value. The income statement should recognize gains and losses in the market value. So here's a question. Assume a not-for-profit receives assets from a donor for distribution to a beneficiary. So a donor gives money to an organization and says, I want you to remit this money to person X. So the accounting issue, if cash or other assets are held by a not-for-profit, with instructions to release this money for specified parties. Is this revenue or is it an agency relationship? Which would mean if it's a donation, they count it as revenue. If it's agency, they count it as a liability because they owe the money to the designated party. And maybe some of you are familiar with this sort of thing if you've ever given money to a missionary. Suppose that you have a friend who's going on a mission trip for mission agency X, and you decided you wanted to help pay for the mission trip. So you write a check to mission agency X, but it's supposed to be paying for that particular person's missionary endeavor. How would you know, how would that nonprofit know whether to count it as revenue or liability? So here's the criteria. If the not-for-profit agrees to transfer the assets to a specified beneficiary, the not-for-profit is deemed to merely be acting as an agent and a liability rather than contribution revenue. So a liability is recorded, not revenue. If the not-for-profit has the ability to redirect the assets to another beneficiary, or if the not-for-profit and beneficiary are related, that would mean, I think, financially, not by family, the assets are recorded as a contribution. General concept. It's revenue if the not-for-profit can control who gets the money. Otherwise, it's credited to a liability account because the not-for-profit is only acting as an agent on behalf of the donor. Exception, if the party receiving the money and the not-for-profit are financially interrelated, then this may be a revenue to the not-for-profit. Example, you want to give financial support to a missionary. If you mail a check directly to the missionary, it's a gift and not a tax-deductible charitable donation. But if you make out the check to the mission agency and designate it for the support of a particular missionary, it's a different situation because the agency could keep the money if the missionary resigned or something. Consolidation of not-for-profits. If a not-for-profit organization controls another not-for-profit, control may be determined by a majority ownership interest or by holding a majority voting interest in the governing board of an entity in which the not-for-profit has an economic interest through contractual or affiliation agreements. This is similar to practices followed in the public sector with component unit reporting. FASB permits two different accounting treatments for combinations by not-for-profit organizations. The central issue is whether the combination's a merger or an acquisition. A merger is a transaction in which the governing bodies of two or more not-for-profit entities relinquish control of those entities to create a new not-for-profit entity. To qualify as a new entity, the combined entity must have a newly formed governing body. Although commonly there will be a new legal entity, that's not a requirement. The resulting not-for-profit entity will account for the merger using the carryover method. Under the carryover method, the new entity recognizes the assets and liabilities of the two separate merging entities and the amounts and classifications reported in the financial statements. No internally developed intangible assets are recognized, such as goodwill. The entity resulting from the merger is a new reporting entity with no activity before the date of the merger. So it's starting its accounting from scratch. Acquisition method, if combinations don't meet the definition of a merger, they're an acquisition. The accounting treatment is similar to the purchase method of accounting for business combinations. The essential element of the acquisition method is that the entity records the acquired assets and liabilities at their fair values, not at the acquired entity's book values. The not-for-profit entity recognizes the identifiable assets and liabilities at their fair values. Non-controlling interest, if there's any, is reported at fair value at the acquisition date and is adjusted in subsequent periods. Whether or not goodwill is recorded or expensed depends on the type of organization. Goodwill, not-for-profit entities that derive their revenues from business-like activities are required to measure and report goodwill as an asset in a similar way as businesses. Recall that the only way goodwill can be created is by purchasing a company at a cost greater than its book value. However, entities that derive their revenues primarily from contributions are to expense the goodwill at date of acquisition. And let me elaborate a little bit on that. When you learn about the concept of goodwill in intermediate, the way I teach it is I say that they're paying a premium for expected future high profits in the company that they're acquiring. Well, that doesn't make sense if it's a not-for-profit organization. So in a business goodwill, it's an asset that represents expected future high profits. But that doesn't make any sense if there's no profits in a nonprofit organization. So the goodwill would be treated as an expense, not capitalized as an asset. Okay, so we have finished that unit, and there were some questions that you might have had about the homework that was due from Chapter 10. Has anybody started that besides Chris? There was a particular entry that he asked about that I want to discuss. So what I'm going to do is I'm going to open up the homework from the textbook. I'm opening Connect right now. Logging in. Waiting for it to open. Selecting the class. Going to the library. Opening the ebook. And take a look at exercise 10-12 here. Okay, so it says in letter C that $417,000 was designated by donors to be used during the next fiscal year in any manner desired by the school. $550,000 was designated by donors for the construction of a new auditorium. Then when you do the homework on Connect, of course, the numbers are going to be different. Down here it says that they spent $780,000 on the construction of the new auditorium. So when you record the construction of the auditorium, you're going to be debiting building and crediting cash because that's what they paid for the new auditorium. Debit building, credit cash. But now we have to go back to part D here. $550,000 was designated by donors for the construction of a new auditorium. Let's go back. I want to open up the solution. Okay, so that is right here is the entry for the cash that was contributed for the construction of the auditorium. Notice that they've debited cash and they've credited contributions with donor restrictions. And time restrictions is, in my opinion, a stupid way of putting it because the restriction wasn't when they're going to spend it, it was how they're going to spend it. But nobody asked me when they set up these account names. So now back down here, when they finish the auditorium, well, that was 550. Okay, that's where I'm wrong. I was looking at C when I should have been looking at D. So capital asset restrictions, that makes sense. They were saying it has to be spent on the auditorium. That's a capital asset. So this contribution is not really considered revenue because they can't spend it unless they spend it the way the owners or the donors wanted it spent. So down here, now that they've finished the construction of the buildings, they have satisfied the donor restrictions. So they make an entry for that dollar amount. So they debit reclassification from net assets with donor restrictions and then credit reclassification to net assets without donor restrictions. So what was recorded here as revenue that was restricted, which is sort of more of a liability, that credit account was debited here. And then now they're recording it as more actual revenue. Questions about that? Does that make sense? Okay. There's no questions about that. I want to move on to the next chapter, which is on college and university accounting. They could hear you. Okay, so chapter 11 and college and university accounting. And the reason this is in a chapter all on its own is because college and university accounting has the unique or unusual, probably I should say, characteristic that some of them are not-for-profit organizations like Belhaven. Some of them are for-profit businesses like Phoenix University, and some of them are government organizations like Mississippi State University. So we're going to take a look at that. It's important when you're doing the accounting to identify whether the institution is public or private. And so in their PowerPoint, they gave an example of two universities that are often confused with each other because of similar names. Miami University is a public university created with a land grant. Land grant was an act passed by Congress and signed by then President George Washington and operated within and by the state of Ohio. So land grant universities, when new states were being formed, they were given charters to set up universities and given land by the federal government to locate them. Miami University is named after the Miami Indians who lived in the southern Great Lakes area. And the university, Miami University, is in Oxford, Ohio, and it's named after them, which has caused considerable confusion. The Miami River in Ohio, there's also a Miami River in Florida, named after the Miami Indians who lived around Lake Okeechobee, Florida. The University of Miami was created when a private citizen donated 160 acres of land and $5 million for the creation of a university in Coral Gables, which is a suburb of the city of Miami. The University of Miami operates as a private, not-for-profit organization and is governed by a board of trustees. Public versus private. The distinguishing characteristic of public colleges is that they receive substantial funding from their state governments in the form of state appropriations. That is, they get lots of tax money. Private colleges generally do not receive state subsidies and must support themselves through tuition, donations, and other income. Now, that's not completely true because a lot of private colleges do get money from state and federal governments, but that's because they're getting scholarship money that actually is for the students. So who has the standard setting authority for colleges and universities? There are three types: private, not-for-profit, public, government-owned, and investor-owned commercial for-profit universities. So 3 examples of each are given. Private not-for-profit, Belhaven University, Mississippi College, Liberty University. They follow FASB standards for not-for-profit organizations. Public government-owned universities like University of Mississippi, Michigan State University, Clemson University, they follow GASB standards. Investor-owned commercial universities, University of Phoenix, Grand Canyon University, Strayer University, they follow the FASB standards for businesses, not the standards for not-for-profits. So FASB has primary authority over private colleges. GASB has primary authority over government-related public colleges. There is one standard, GASB 35, specific to public colleges and universities. And some accounting guidance is given by NFPO, which is sorry, something was boiling over. I had to interrupt the class. NFPO, National Association of College and University Business Officers, provides additional guidance for both public and private colleges and universities. So, overview, public institutions. Most public colleges and universities report as special purpose governments engaged in business type activities. So then they may appear as discretely presented, that is separate component units of the state government. Their financial reports closely follow those of enterprise funds, which we already learned about, measuring events using the accrual basis of accounting and the economic resources measurement focus. They'll use enterprise fund reporting because, number one, even though a significant part of their budget comes from tax monies, they also charge students for tuition, books, room, and board. Second, the accounting needs to be more comparable to that of private colleges and universities, which use accrual basis accounting. So if they use the fund modified accrual basis, you'd have two universities that were very similar to each other using completely different accounting methods. And that would not be comparable, which is a required purpose of accounting that you learned about. Private institutions, like other not-for-profits, follow standards established by the FASB. Their financial reports closely follow those of other not-for-profits, such as the public charities described in Chapter 10. Full accrual basis. Most private colleges and universities are incorporated as not-for-profit organizations. And are directed by a self-perpetuating board of trustees. The trustees hire the president, who hires the remainder of the employees. There are no investor interests. And by self-perpetuating, I mean that when someone's going to rotate off their board, the existing board members elect someone to take that place. So here is a summary. I think I need to go to the PowerPoint presentation and enlarge this as much as possible because the print is so small. Okay. Um, okay, that's as big as we can get it. So here we've got the three types of entities: public, private, not-for-profit, and investor-owned that are proprietary. The accounting standards for public, GASB. The financial report should contain management's discussion and analysis, statement of net position, statement of revenues, expenses, and changes in net position, statement of cash flows, notes to the financial statements. The equity section of the statement of net position, which is what GASB calls it, or the equity section of the statement of financial position, which is what FASB calls it. So GASB says that colleges should have net investment in capital assets, and then net position is either restricted or unrestricted. So it's not completely comparable, mainly because of these differences in this column. Private ones, statement of financial position, statement of activities, cash flows, notes, a statement or schedule of functional expenses. The net assets are divided into those with and without donor restrictions. Investor owned, instead of, well, they have the addition here of a statement of changes in owner's equity, since they are investor owned. And so that would, like any business, have a paid in capital section with shares of stock and so on, and retained earnings. NFPO was mentioned before. It's an industry group composed of university financial vice presidents, comptrollers, and other finance officers. Both public and private sector institutions follow guidelines issued by NFPO. They publish their recommendations in Financial Accounting and Reporting Manual for Higher Education. The manual does not supersede GASB or FASB standards, but it provides guidance on issues that are not specifically addressed by either of those boards. For example, colleges often issue tuition discounts and other forms of financial aid, such as scholarships. And so neither GASB or FASB said whether these are expenses or contra revenues. So if you gave a student a scholarship, do you record a scholarship expense and then record the full amount of tuition revenue? Or should you record the amount of tuition revenue and offset it with like an allowance for the scholarship? NFPO's advice is that scholarships, including athletic or academic, that do not require service to the college or university, are to be treated as reductions in revenue. So they'd accomplish this through contra revenue accounts. On the other hand, fees waived by the institution in return for services provided by work study and graduate student assistantships are shown as expenses, and tuition and fee revenue is reported at the gross amount. Berea College is famous for charging no tuition at all to students. The college is funded by government student aid, a large endowment, and students have to work without pay at least 10 hours a week. Founded in 1855, it was the first co-ed and racially integrated college in the South, but not in the USA. the college I went to was co-ed and racially integrated in 1844. So the students working at Berea, their tuition would be recorded at the gross amount, offset by the work study. If a tuition or fee reduction is an employee benefit, work study, or graduate assistantship, the reduction is treated as an expense. Academic scholarships that do not require service to the college are treated as reductions in revenue. NACUBO academic terms encompassing more than one fiscal year. Because colleges and universities commonly use June 30th as fiscal year end, tuition for summer school frequently covers parts of 2 fiscal years. Because in a lot of places, their summer school is June, July, and August. So NACUBO requires that both revenues and expenses, if you had such a term, be apportioned to the 2 fiscal years in a manner similar to that followed by commercial organizations. Belhaven has 2 summer terms. The first one is mostly before the fiscal year end, and the second is in the new fiscal year. So that would not be an issue for Belhaven because the terms break around the June 30th mark. Functional categories for expenses are recommended by NACUBO, and they say that they should have categories of educational in general, auxiliary, hospitals, and independent operations. Educational in general would include instruction, research, public service, academic support, student services, institutional support, fellowships. Academic support includes expenses incurred to facilitate instruction, research, and public service, which would be, for example, libraries and computer labs, along with teaching salaries. Institutional support includes expenses associated with central management, planning, and administration. So at Belhaven, the president's salary would be institutional support. Library salaries would be academic support. Auxiliary enterprises, residence halls, dining services, and bookstores. I don't know how it would work now reporting for Belhaven since the bookstore is contracted out to Barnes and Nobles now. Hospitals, some universities have teaching hospitals. So the University of Mississippi Medical Center is an example of that. It's part of the University of Mississippi, and all its operations would be included in their financial statements. Independent operations, research and development centers, that's usually a place where they're doing on the campus research that's funded by outside grants. And usually only the major universities do that. So revenue items are reported as operating or non-operating. Operating revenue, tuition and student fees, grants and contracts, whether they're federal, state, or private. Auxiliary enterprises, since dormitories, bookstores, what was the other one that they had? dining services. If you have a residential university, they're a pretty essential core part of what's going on. Non-operating investment income, gifts and donations, state appropriations, that's public tax money, Pell Grant revenue, that's public money that's given to pay tuition for students, private contributions that are time restricted, and net assets released from restriction. We've gotten to our 40-minute limit now. So anybody have questions before we wrap it up for today? We should finish this on Wednesday. And then I sent you an email this morning to remind you that Friday is Good Friday. There's no classes. I'm sure that you've got plenty of work to do in catching up on homework assignments and writing assignments for all your classes. That you don't need another lecture. I'm hoping we can cover all the material that is scheduled, but we'll see. We can only do so much. So questions or comments before we go? All right, then, I will see you all on Wednesday. Take care, be very careful. Bye now.